Residential sales comparison and income approaches, page 184. Direct capitalization, using an overall rate. Direct capitalization, using an overall capitalization rate, is an income method that converts a property's single-year net operating income, NOI, into a value indication by applying an overall capitalization rate. Here's the formula. You take your net operating income divide it by an overall capitalization rate will equal value. The direct capitalization technique is considered by most to interpret typical investor reactions and motivations of a particular property. Be careful, however, to not confuse direct capitalization with yield capitalization, which considers a series of cash flows rather than a single year's income. The direct capitalization technique is most relevant when the property's occupancy and net operating income are stabilized or established. There must also be relevant comparable transaction data available that can be analyzed. The development of the direct capitalization technique requires two major components that are used in the final analysis from which to form conclusions. Number one, net operating income. Number two, overall capitalization rate. Determining net income of the subject property. The net income or net operating income, NOI, of the subject property is the estimated amount the property owner or investor should realize or did realize after accounting for certain losses and operating expenses, including replacement reserves for the property. The steps in estimating net operating income require a systematic and careful analysis. The steps are: number one, determine potential gross income. Number two, estimate rates of vacancy and collection losses. Number three, determine effective gross income. Number four, estimate the operating expenses. And ultimately, number five is determine the net operating income. While these 5 steps may seem outwardly simple, the appraiser may spend a significant amount of time in analyzing the various components leading to an estimated net operating income. For direct capitalization, the methods considered all of these components on an annual basis. The mathematical formula for net operating income is as follows: potential gross income minus vacancy and collection losses equals effective gross income. And then figure out what the operating hour expenses are and minus that from effective gross income. That'll equal your NOI, net operating income. Direct capitalization using an overall cap rate uses the NOI of a single year to indicate an opinion of value. Page 185. Estimating PGI, potential gross income. PGI, potential gross income, is the amount of income that a property is capable of generating if all the units are occupied without vacancy for the full year and all rents and other anticipated income are received without collection losses. Of course, by the very nature of gross income, potential gross income is estimated before any operating expenses are deducted. Potential gross income, as we have discussed with any rent or income applied in the income approach is based upon market rent. And while the contract rent of the subject is analyzed, the analysis is for the purpose of determining if the subject's actual or contract rent reflects a market level. For this analysis, the appraiser reviews leases of the property, or in this case, of more than one unit, possibly a rent roll. A rent roll briefly details the unit information, lease terms, contract rent, as well as the effective date of the leases that are in place for the property. Some will have more or differing information than this, but let's look at a simple rent roll. For example, the subject of an appraisal assignment is a 4-unit apartment building. All apartment units are on the first floor and are identical, with each having a living room, a kitchen, 2 bedrooms, and a full bath. Each of the building's units is currently rented by a flat gross lease. Here is the rent roll for the property provided by the owner. It shows a grid. The first part of the grid says unit, and then it goes down for unit 1, 2, 3, and 4. The next part is tenants. Unit 1's tenant's last name is Smith. Unit 2 is Jones. Unit 3 was Brown, and Unit 4 was White. The next section of the grid is the original lease date. For Unit 1, tenant Smith, it was 24 months ago. For Unit 2, tenant Jones, it was last week. For Unit 3, tenant Brown, it was 3 months ago. And for Unit 4, tenant White, it was 20 months ago. The next part of the grid is lease term. For Unit 1, Smith, it was 3 years ago. For Unit 2, Jones, it was 1 year. For Unit 3, tenant Brown, it was 1 year ago. And for unit number 4, tenant White, it was 3 years ago. The next part of the grid is the rent. Unit number 1 rents for $650 a month. Unit 2 rents for $700 a month. Unit number 3 rents for $700 a month. And unit number 4 rents for $600 a month. The next part of the grid is term remaining. Unit 1 has 12 months remaining. Unit 2 has 12 months remaining. Unit 3 has 9 months remaining. And Unit 4 has 4 months remaining. The last part of the grid is escalation clause. All the units don't have an escalation clause. At first glance, it can probably be concluded that rents being produced by unit number 1 and unit number 4 are probably not at market level. These leases have been in effect for a while, and given that the more recent leases for unit number 2 and unit number 3 each are at $700 per month, it is likely that unit number 1 and unit number 4 can be supported at a higher rent for the purpose of estimating potential gross income. The appraiser, however, must confirm through analysis of similar market data that $700 per month is a reasonable reflection of market level rent. As part of the analysis, an appraiser may compile a rent survey. A rent survey is a completion of the rents being generated and often a rent history in a particular market for a particular property type.